Hello, everybody, and welcome to My Print Hash for week 27 of 2026. I'm your host, Cameron Otsuka, and as always, alongside me, Matt Dines. There's been a ton of big developments this week that we think really set the stage for future headlines, kind of future things that we think might come down the pipeline. I'm sure that we'll want to cover. But we'll start with the Supreme Court's ruling on Lisa Cook and the Fed. Then we'll move into the launch of a new stablecoin and why its structure and kind of the participants are so interesting to us. And then finally, we'll round out the episode talking about sovereign bond land and something that I think Matt has kind of called out as the Brady Plan situation that's kind of unfolding here. So with all that said, we're trying to get through this episode. There's a lot to cover, so bear with us if we're a little bit long this episode. Let's start with the Supreme Court. You know, Matt, we've been hearing the Supreme Court has been hearing the Trump v. Cook case. Walk us through kind of your assessment of what's going on, what went on, and then finally kind of what it might allude to in the future.
So this week was really the big bounty of Supreme Court decisions coming down. Key one of those earlier this week was a decision that I think opens the floodgates to future kind of rulings on the broader picture of the Federal Reserve, the monetary structure, everything along with that from the federal government's perspective. That's never really been opened up in the 110 plus year history of the Federal Reserve as an institution since the Federal Reserve Act of 1913. So we're going to find out over the longer term how this whole series of events plays out. But this decision, which was specifically regarding the issue of the president's executive power to remove an FOMC board of governors seated official for cause. This is really just opening up the can of worms, in my opinion. So, to make the long story short, nothing happened, but then everything happened, right? Nothing happened. I say that in terms of the status quo was maintained, which was just upholding a prior injunction from a lower court to block that removal process of Lisa Cook being removed from that FOMC board seat without due process. Nothing really changed there. The Supreme Court just narrowly upheld that right from the seated official to, I guess, like state their case, maintain due process of law, all of that. But the bigger picture is, in my opinion, embedded in the dissenting opinion. We'll get that in a second. But just given the rapid evolution that our view holding at the structural layer to the monetary system in our times, like States, but then also internationally with that transition from the old offshore dollar we talk about, we'll get to down the road towards the stablecoin dollar framework. I'd say expect this Cook v. Trump decision to be just the first of several cases that opens up this broader topic of legal debate in the years ahead. So, let's get into we talked about upholding the employee, or I don't know if you'd be considered an employee as a board member, right? But your right to due process. What I actually think will be the lasting repercussion here, most impactful in the long term, will be the dissent, specifically what is embedded in Justice Clarence Thomas's 21-page dissenting opinion. So what this does is now, if you think about the chain of Supreme Court official opinions that other future and future matters that arise before the court, these opinions, whether they're the majority opinion or a dissenting, could be like a confirming or alternate opinion on either pro or con, what have you. These form like a paper trail, a track record that future judges can cite on those matters as they come to the attention of the court. So I noted the Federal Reserve Act, the institution itself, it's never really made its way before the court in over 100 years. It's kind of by design. We've been trying to kick the can uphill, and we'll do things in times of need, legislate, judicially, et cetera, to just maintain the status quo, or just move things along so we don't have to let things go, or fall apart, if they will. We do what needs to be done, kind of what's the right word, reactively as opposed to proactively, I think, is the case for people involved in this process in Washington, D.C. Just my opinion.
Yeah.
But as we go through like this process, we talk about the monetary transition underway. I think what we just saw, and specifically in this dissenting opinion that we have up on the screen, just the first page, this is ammo for that process as it unfolds. It may not be, these same justices. You're going to have, natural people leaving, retiring, et cetera, on the Supreme Court, new justices appointed, new matters will arise as kind of society, government, all of us, like everything, like these issues, like what can't continue to stand without some ruling or some establishment for future stability. These will get pulled in on those topics. So some things I want to call out here. So first, Justice Thomas notes that this decision to uphold this injunction that we talked about with in favor of Lisa Cook, this is the first in constitutional history that the Supreme Court has stepped in blocking the executive from removing an officer of a like a quasi-public institution or a government agency, that sort of thing. So this just hints something special here. We're doing something novel for the first time. I want to make sure we're taking note of that as we look to what's going on in this Cook v. Trump decision. I said nothing changed, but in reality, Clarence Thomas is pointing out, oh no, you are actually changing things. Second, he points out this inconsistency that an independent Fed exercising its own executive power without presidential control, like ultimately the chief executive of the federal government. Ultimately, those are arguments against the Constitution, right? Separation of powers, all these enumerated powers that go along with the office of executive. Third, the majority opinion provides some selective insulation for the Federal Reserve that's not coherent. It is incoherent and violates those same separation of powers principles. And fourth, and this is part of the majority opinion's ruling, but Justice Thomas rejects this framing of the FOMC board member seat, or any public office seat for that matter, as Lisa Cook's property. Right? These seats, these aren't heirlooms. You can think about it, same thing, a senator seat, a congressional seat, agency head, or roles, appointees, all of that to this federal government like bureaucratic blob, right? These aren't fiefdoms or heirlooms being passed down between individuals or families, etc. Justice Thomas really points out that idea itself is not consistent with the Constitution, the framing, what the revolution was fought for in the first place. So he's really bringing to light, he's bubbling up a lot of key issues to the surface that are not just kind of tantamount to this monetary transition we talk about. Like, oh no, this goes bigger. This is how we have come to address politics, governance, rule of law amongst elites or families themselves, who I think, if you look at traditions, right, over the last, let's say, half century to a century, if you just roll back the tape, we've seen examples of families like Clintons, Bushes, etc., like dynasties, all of that. I think Justice Thomas is really getting something here, getting to the heart of the matter, and as it usually goes, money as a central feature in the role it plays in society. That whole sore spot that is kind of exposing itself and coming to the surface in American society more broadly. I think Justice Thomas like pointed it out here perfectly. And then lastly, Justice Thomas in this dissent just injects a deep history of the Federal Reserve itself and its roots as an institution derived from kind of more of a European autocratic or elitist family tree. Um, and that structure itself is inconsistent with the American systems framework or our constitutional principles. So this 21-page dissent is huge. Yes, it's on the losing team in this battle, but just getting this thing into that archive, into that record for the future battles, I think this was the actual longest lasting impact, I think, coming out of this Cook decision and the matter more broadly as we go through this kind of process over the coming years, right? This is going to take time, but it's brought all of these, underlying kind of wounds from like the superficial level and brought them all to the surface.
Yep, 100%. And so from there, let's talk about the kind of the broader, you talked about this transition from a political system, broad-based governance over the United States, et cetera. So let's talk about the monetary system itself. Let's move on to first some context, right? I really wanted to start with some other stablecoin issuers that are already out in market. The first one here is Tether. They run one of the largest offshore, if not the largest, stablecoins right now, really focused on the offshore dollar, right? So they have already come out and said they're not going to be a Genius Act compliant stablecoin. If they decide to do that, they would be a different version of USDT.
The clarity there, you've got the old USDT Tether.
Yes.
That thing is just kind of going, right? It's just limping along. And then Tether is going to launch the Genius Act compliant stablecoin. It's the USAT. So
that's a separate stablecoin. Yep. Yeah, no, that was the right thing to point out, because I don't want to speak incorrectly about that. But then again, so on the EU side, they have their own version of Genius Act, which is these MiCA licenses, MiCA, essentially requiring certain types of reserves to be held. Tether has, I have this here. This is from one of Paulo Arduino's interviews, where he basically just says, we're not going to do this. We're not going to be EU compliant because, as he calls them, uninsured cash deposits at small European banks are unable to handle the redemptions necessary for a stablecoin like Tether. And you can see it right here. I've got the reserve breakdown for Tether. There's 74% cash and cash equivalents. So that's kind of your treasury type of an instrument. But you'll see towards the right here, you've got precious metals, you've got Bitcoin, you've got public equities, etc. So, clearly the way that Tether is running their kind of stablecoin stack is very different from what we're seeing elsewhere, right?
I see this as a natural resistance. Sorry to interrupt, but I think if you're Paulo Arduino, I haven't heard him say this or lean into it explicitly, but just knowing digital euro is coming, the savings and investment union is coming, all of what I view this as is he sees that honeypot, right? And it's like, no, we're not going to put our reserves into that thing, which is how I view it. So big, the quiet part wasn't stated out loud, but it's very clear. Tether, Paulo Arduino, et cetera, they're not going toward that honeypot, if you will, that's been set up by EU, ECB, et cetera.
Sure. Yep. And also to note, they run probably one of the world's most profitable companies per employee. I forget the exact numbers here, but I believe they have about 140, 150 employees as of the last time there was some public reporting on it. So on a per employee basis, massive profits, which means what? Pretty massive margins, right? So then secondarily here, we've got Circle, just kind of highlighting a different style or flavor of stablecoin here. Again, Circle is a Genius Act compliant stablecoin. They have all their reserves one-to-one in cash or US treasuries or treasury-like instruments, that sort of thing. But one of the big differences with an issuer-led stablecoin like Circle is that you need to actually have partnerships or find ways to distribute your coin and convince others to use it, right? So it's not enough to just go out and say, hey, we made a stablecoin, congrats, let's all hop onto our rails. You need to find ways to convince people through marketing or through other means. And so in this case, I'm highlighting here the Coinbase revenue sharing agreement, which I think is one of the most important, probably largest deals for the stablecoin space. But essentially, Circle is asking Coinbase, hey, promote the use of USDC on your platform, help market it, etc. And when you do that, the amount of USDC that you're able to actually use through your platform or generate demand for, that will be part of the I'm not going to call it commissions, but part of the revenue that is shared back with you. And again, Tether and Circle don't have to pay interest back to depositors, right? So that's a big difference between banks. Circle's revenue stream is just the yield they earn on their reserves. So Tether, Circle, these are kind of top down, right? I called it issuer led. Circle's deciding who and when to mint or burn the token. They've decided to partner with Coinbase. They've negotiated out a contract on how much revenue to share with Coinbase. But one of the key points here is that it's very difficult if you're a Coinbase to actually make any money unless you partner with somebody like Circle. So I think that's where we enter in OpenUSD. And I just want to call it straight out the gates, there's 140 plus partners pre-launch. I think that took me by surprise when I saw it. I kind of had to take a step back and understand why, right? So I talked about Circle and Tether specifically because those are issuer-led. OpenUSD, slightly different model, right? And I'm going to flip over, well, before I do that, I'm going to kind of point out the categories of industry. So on the right hand side here, you've got Visa, Stripe, all your payment processors. Below that, you've got BlackRock, BNY. These are your banks. You've got your tech companies, and then you've got other crypto related companies, right? So they're really trying to showcase, hey, we've got the gamut of companies that are already signed up, willing to hop onto our rails as soon as we're up and running with OpenUSD, OUSD for short. But to me, the key parts here are, number one, governance. Open Standard is saying that they're going to be governed collaboratively. Very different, right, from Circle, who just decides, here's how we're going to run the USDC stablecoin. And then two, economics are going to be shared. So all of the revenue generated from reserves minus a small management fee go to the participants who adopt and distribute it, right? So if we talk about, if you flip that model on its head, Coinbase, Stripe, I think, has already come out and said that they're going to be day one migrating all stablecoin users onto OpenUSD if they can, as their default kind of form of payment. It just kind of shows you where the puck is moving for the distribution channels, right? They're actually able to share in that revenue versus having to sign these individual agreements with Circle or Tether or other stablecoin issuers. But the key point to me here on governance, and to kind of tie this back to what Matt was talking about with what we're seeing in politics and in the legislative branch, in the judicial branch, is that governance, I think, is going to be key here. There's 140 plus partners. That means 140 plus potential voices in the room trying to decide on where OpenUSD is going to go, what they're going to do with it, how it's going to function. I do think there's some potential for too much bureaucracy, right, to enter into the process. Mm-hmm. But on the news, this is a chart of Circle. Circle obviously took a hit here on the bottom right, the most recent dates. To me, again, it's really a case of who's going to win out in terms of the issuer-led versus distributor-led models. It's possible that both end up taking the cake over time, but on the distributor-led model, what this really means short term is that there's more leverage for them when they go back to the negotiating table. When if a Coinbase goes back to Circle and says, hey, I want to renegotiate our revenue share deal, if Stripe decides to go to Circle and say, hey, I've already signed up for OpenUSD, over here I'm getting, I don't know, 60%, 50% of the revenue from the usage of OpenUSD. With Circle, I want to get a similar or higher percentage, right, or something like that. So again, I do think that some of the news could be negative for Circle, but for this, I want to turn it over to Matt. I think you had a broader point about stablecoins generally, and this is where you place this arrow on the Circle chart. So maybe explain what you saw that might be a little bit not different, but might explain a little bit more about where the trend is, where the puck is headed with stablecoins broadly.
Yeah, I have another topic to get into here, but I just want to call out. So, roughly February 5th, you see the bottom of the chart on the lower left. This is the stock chart. This was before Operation Economic Fury, but yeah, Circle bottomed near the same time as we saw, Bitcoin. Still, I think is its year-to-date low on February 5th. I think it's held so far. There is a sell-off in Bitcoin going on as we speak. Um, but I found it interesting that when Operation Epic Fury was announced on February 28th, the reaction from Circle and this as a signal for the stablecoin dollar and its own economic prospects, it actually rallied coming out of the Iran theater opening up. So you see that on that jump from late February all the way up to mid March. So this
Yeah.
stablecoin dollar transition, I think, to keep at the back of your mind, it liked what it saw from this administration and the military opening up this action against Iran. So found that to be um, worth noting. All right. Last, you see that gap up right from February, but you've seen recently on this news, hey, there's new competitors here. You've seen Circle on that sell off on the open standard announcement earlier this week, break that gap. So we're in that middle of no man's land. My thesis here, right? You've got multiple players now, multiple business development approaches entering, or strategies, if you will, entering this stablecoin game. Obviously, Cameron, you talked about Tether, you got Circle, now you have the open standard. Um, they're just different strategies for ultimately garnering adoption into a given stablecoin. If you look out at the story, yeah, we're looking at competitors who will enter this arena as they go out and chase this prize. What is that prize? We'll look at this chart: interest payments, interest expenditures from the U.S. Treasury, right, the federal government. Everybody talks about that chart going up and to the right. This is the nothing stops this train phenomenon. What we're actually seeing happen here with this open standard and 140 other big names in the financial industry, that's telling me is this is the prize, right? They're going after this because as a business, this is the market where you want to like take market share in the future. So I view that development we saw out of Open Standard, the CEO coming from Bridge, which was acquired by Stripe. I see this ultimately as another positive development, like to that broader picture we're talking about, that transition away from the offshore dollar towards the stablecoin dollar.
Yep.
Um, but here, yeah, the ultimate winner, there's no winner yet. Like it's too early to say which of these approaches is correct. Is it would you call it the issuer push model, where you're thinking like business development, Circle, um, they go proactively working on bespoke one-on-one deals with Coinbase, Polymarket, et cetera, to ultimately find distribution for their stablecoin? Or is it you reverse the direction of those arrows on the hub and spoke graph and you say, oh no, this is issuer pull. The issuer doesn't have much budget to take um, business counterparties out to a nice steak dinner or wine and dine them, whatever. The issuer comes to Open Standard or the OpenUSD stablecoin because it's just take it or leave it. You're going to get some share of the interest income on this, the majority share for the stablecoin reserves that you bring into the table from your own little distribution hub. We'll see which one of these business models plays out and ultimately takes the greater share of the pie. My point here is the big pie, and we're already seeing all of these, key financial institutions like the heavyweights are already coming in and going after this thing. So positive development for the U.S. Treasury in the bigger picture, and yeah, positive development like on track for the stablecoin dollar transition.
Yep. So then
Cool.
let's move, Matt, to the final topic of today. You pulled this out of the archives, basically. Just maybe explain to me and to the audience here the Brady Plan and kind of what you were seeing that kind of made you think about this. straight out the gates?
So old newspaper clippings here. This is from a development 40 years ago from involving the last major Latin American debt crisis, which was addressed through the U.S. Treasury Secretary Nicholas's Brady Plan is what it was called, or Brady Bonds. And I'll get into what that means. But basically what happened, right? Everybody knows we had the oil shock of the 1970s, the inflation in the dollar. We break that thing. Volcker hikes rates to basically give the body a fever, right? So we sweat out the inflation, hike interest rates to 20. We reset, U.S. debt to GDP back down to like the lowest levels they've been in post World War II, and from there, that created the backdrop from basically like 1982 onward, where we just expand this offshore dollar pie because we broke the link of the metals tie, or peg to the dollar, silver domestically, gold for international capital transfers, and we went purely to an IOU, liability dollar standard. All right, what that did in the rest of the developing world. So bottom right, you see oil prices, right, per barrel indexed to 2013 constant price levels. After that 1970s run up, beginning on the left hand side of the chart, you saw oil markets collapse, right, as this dollar system transferred from the asset backed dollar we talked about, based on the precious metals peg dollar. What that did is it put the developing world into, like debt crises, right? I guess there's no other way to put it. And so what you had is all of these commercial banking systems. Like, I'm going to specifically focus on Mexico. You had a lot of bad dollar denominated debt that the banking system, mostly in Mexico, but it also crossed borders. Like, there were some U.S. banks who had exposure to these loans as well, and you could say broader Latin America. The recipe for getting those out, or getting out of that debt situation, that debt overhang, was developed by U.S. Treasury Secretary Brady. And in a roundabout way, what they found a way to do was make these bad loans in dollar denominated terms, turn them into good loans by with reserves, right, from say Mexico or another Latin American country, or getting them to buy zero coupon 30-year US Treasury debt that was custodied in New York. And then what they did is basically a transformation, like a three-card Monte scheme, to turn those bad commercial loans into high quality, liquid, sovereign denominated debt that then could into the banking systems and recover their balance sheets back to health. And what this actually represented, in my mind, is incorporating the Western Hemisphere developing markets into the offshore, Eurodollar order, is what this actually represented. Now, notice the security here, the collateralization was these 30-year zero coupon U.S. Treasury bonds that were, specially created by these entities like IMF, World Bank, et cetera, to make this structure work. Notice the 30-year clock. The system was basically 1990s era. Roll the tape forward 30 years. This whole patchwork scheme is coming to its end, and what we're seeing here, activity, and we can talk about sovereign debt markets. We'll get into that, but specifically in Mexico, what I view this as is like we're at the transition, one end of the bookend. This thing started in the 90s, 2020s. We're here on the other end of that wave, and it's now time for, say, Latin America, developing market debt specifically. But I think front and center, what we're seeing here in market signals is telling us Mexico is, and we've opened up that theater for their integration, make or break into the new stablecoin dollar order, or find some other competing alternative. I guess we'll leave it at that, because it's going to take another alternative. And right now, I don't see what it is. It's just more of the legacy kind of system, the old offshore dollar trying to resist at this point, more so
Sure.
than having an actual challenger. All right. So key things here in sovereign debt land. Focus on the plots on that column where I have the circled yields I want to focus on. But the two who are standing out at 52-week highs, or sorry, this is 3-month, but you could say, like, if you just extrapolate this to the 1-year look back, you'll see a very similar pattern. Mexico's dollar denominated bonds are showing, high end of their yields. Same thing with Japan. So everybody is broadly following, like, there's plenty of attention on the Japanese yen and JGBs, et cetera. That's well covered. It is a story. It is part of this, and you could even say it's the catalyst. But what you're probably not hearing a lot about is the Mexico dollar-denominated situation. And the last one, I'm not going to dive too deep into this, but you see the rails on EMEA, or you could call this the Eurozone area sovereign debt. Look at those two rails with the yellow lines, all of those blue dots where the country specific yields are lined up nicely. One of these things is not like the other. France, to call that out, it's the nail sticking out that probably gets the hammer. That's not a story for this week, though. Just continue to watch that, though. The French government situation is telling you, versus its peer group, something is probably in store for that if you had to bet on it. But I want to focus today on Mexico, the US dollar bond. Notice, though, this isn't just an all Latin America dollar denominated debt problem. Why do we say that? Well, we got two peers right here. You got Argentina, where spreads on their dollar bonds have been coming in, right? It's the opposite direction of what you're seeing with Mexico's. And then Brazil's dollar denominated debt. Roughly in line, almost the same yields as Mexico right now. They're within 2 bips of each other. They're at the midpoint of their range. Nothing too big going on at this point. Although you do have one of the most important elections of the year in my framework, with their presidential election coming up in, I think it's September, with Lula on the ballot. Probably the second biggest election for the rest of the second half of the year, with the US midterms being number one, obviously. All right. So, Cameron, if you go next, you can see here, this is just the chart of the Mexico's 10-year dollar denominated yield. So I want to point out, if you look back on the 1 year, it's like, yes, these are moving up in terms of higher yields, but you can see that a resistance here at about 6.75%, that ever since we got into this transition, steering the dollar away from the offshore dollar system and then towards this stablecoin dollar emergent long-term time horizon, right? This is going to play out not just in a few years. Like, spread this out. This transition is something you can expect it to take the better part of a decade. Really be prepared for that type of horizon. But you can see there's, if you look at the pressure that this underlying phenomenon of higher U.S. Treasury yields is, well, the last couple of months we've seen a strong dollar environment. If you just look at the DXY chart, I don't have it here, but all of this together is pressuring Mexico's sovereign debt yields up, and this is just part of the broader backdrop that we're talking about here as we get into these big developments that have happened in the last 2 months, but went almost totally uncovered in the broader financial discussion. So something that went over the head of a lot of commentators, most podcasts, if you're trying to stay informed here. Big development happened in May, late May. Moody's and Standard & Poor's cut Mexico's sovereign like triple B down to a triple B minus, right? That Moody's notes is at this point stable after this this latest downgrade. But I want to note here, this is a triple B minus, or in Moody's terms, it's a Baa3, same thing. But it's that last rung where your credit rating is still investment grade and you have access to the investment grade dollar credit markets. Now, investment grade dollar credit markets are massive in comparison to the capital pool that you have available to you as a junk bond or high yield issuer or non-investment grade issuer. So if you lose access to the investment grade markets, you lose like your available pool to tap into for liquidity, it drops a ton. So if you're Mexico, you're kind of like it is very important to you to hang on hang on to that last rating from here. All right. Mexico, like specifically in the Moody's report, they noted there's sustained weakening in the fiscal strength that accelerated in 2024 is where they first noted it, and that weakening is expected to persist. So, what is that weakening? It's reflecting that big transition in, you could say, the dollar itself that we talk about, also the pull in yields from the U.S.'s own sovereign debt situation. And then it's also, to a large degree, trade in those interactions with the US and Mexico representing the largest bilateral country trading pair in nominal terms. So, side development, we won't get into this week, but in the last day or two, President Trump allowed the USMCA to relapse. So basically, it turns into now instead of a long-term trade deal, it's up for annual renegotiations at this point. All right. So what this kind of broadly reflects everything going on here. We talked about the credit rating falling, the underlying deterioration in fiscal strength. This is part of that process where Mexico now is kind of like we said, they're at that end point of that temporary stability that the Brady Plan kind of offered them as one of the largest Latin American economies, right, in this old offshore dollar framework. They're now at that fork in the road, same process as kind of the US went through as we describe it in 2022, choosing one direction or the other in the United States. I think Mexico now is at a similar fork in the road where they're going to have to make that choice. Ultimately, because this is the largest bilateral trade pair in the world, if the US goes one way, it is going to be almost impossible for me to see a world where Mexico isn't coming along with it. But if you look back on the broader 300 plus years of interaction between the American colonies and what it's grown into the United States and its interaction with Mexico, you could say the same thing with Canada or British North America, right? Um, you can try to go against what the United States wants to do, but ultimately you're going to be economically a lot better off as Mexico in a sovereign sense. Like if you're playing for the home team, you're much better off going with the United States in my view. All right, so yeah, for just to sum it up, we're at where the Brady Plan's kind of duct tape and baling wire solution needs to find um, a new path for Mexico's own sovereign debt situation. All right. So what we've seen come up in the short term to address hiccups that are likely incoming, we just saw Mexico's central bank, the Banxico, add a bond buying toolkit to use as a backstop to its own debt and money market situation as we work towards this bottom that's coming in the short term credit cycle. So think of this tool like what would this be? It's an emergency liquidity tool from the central bank to address, like, let's say a repo rumble type of event like the US experience in its own money markets in 2019, for that situation if and when Mexico's money markets veer off the rails. Now keep in mind you can provide all the emergency in Mexican peso terms, but to do it in US dollar terms, that's when you're attached to the bigger, fish in the sea, which is the United States and what it's doing pulling control of the US dollar back towards, its own, domestic onshore economy, um, and away in the center of gravity away from offshore London, etc. All right. So I got two rates here. The blue chart, the shaded one, that's Banxico's short-term overnight borrowing rate in Mexican peso terms, and then the yellow is their 10-year yield in local currency. But you can really see here as the credit cycle bottoms, um, what happens? Well, those cuts that are in interest rates start to diminish, right? And that ability to keep lowering and lowering rates, eventually that runs out of steam. Once rates want to start rising, or overnight rates, all of that, they bottom out. The central bank runs out of capacity, and the economy, the financial system, run out of capacity to keep credit expansion going. All of that stuff to ease in the money market, uh, interest rate cycle, all of that. What happens is you bottom out, and then once that's over, local currency borrowing costs tend to rise, and that's where we're talking about those same things we were highlighting in the Moody's report about the worsening fiscal position. It just worse, right? So that's where you're looking to things like the framework for the United States being in a pickle. Nothing stops this train. We're going to QE, etc. If you actually look to the other players across, like sitting around the table, it looks to me like this cycle, like the U.S. Reasserting its control and dominance over its U.S. dollar. It's actually passing the buck on to the other players at the table and forcing them to react. Um, so this is kind of part of the bigger picture that we've seen in the Western Hemisphere in at an accelerating rate, right? This is just adding financial pressure in the capital markets arena onto the bigger power struggle developments we've seen taking place in countries like Venezuela, Argentina, coming soon to Cuba, Mexico, etc. And you've already seen the military and financial sanctions in Mexico with the targeting of cartels, um, which ultimately bubbles all the way up to the top of the country's governance and institutional structures. So this will be a big development in the years ahead. Like this isn't something that's just going to work itself out over like weeks or a quarter, in my opinion. This is something that'll take a bit longer, quarters, years type of situation. But this process has already started. Like the snowball's rolling down the hill. You're seeing the developments in credit ratings, its debt markets, its central banking policy tools, saying we're gearing up for that fight. Um, and as I said, because the U.S. and Mexico represent the largest bilateral trade pair in the world, like that's, we talk about prizes, right? The interest income on the U.S. Treasuries, right, being
Right.
what all these stablecoin dollars are going for. That trade pair, right? That is a prize unto itself. So for something else to come in and displace it, you have to provide a bigger pie or like a bigger trophy to go after for private sector operators to chase than what already exists, which in my mind seems unlikely. Like that is a huge. It's hard to make a bigger prize than the biggest prizes that already exist, right? So I would say for the longer term, the most probable end game out of this is an alignment into the U.S. Treasury stablecoin dollar architecture that is emergent for Mexico, which is part of the theme of like think about it, the entire Western Hemisphere starting to organize around this emergent framework, and then that all roots back to Bitcoin at the end of the day. But we'll just put that one aside. All right. So finally, just the end of the quarter close on the Japanese yen to bring it home, FX and sovereign debt gave a strong tell that major developments are in store in the foreign exchange and sovereign debt complex, and coming weeks, months, couple of quarters. But this is like right around the corner. It is what the charts are kind of flashing in my read. Um, the yen was unable to close the quarter below that 160 level, which has been a key support over the last couple of years. Um, that itself is an output of the imbalances in cross-border capital flows and excess leverage and the Japanese yen denominated borrowing that's now coming to an end, with the U.S., Japan, its trading partners who are aligned in this monetary transition, forcing the envelope, and pressing the issue. Um, so here, if you're looking at this in the big picture, we talked a lot about Mexico, but the Japanese yen, look to it as kind of your representation as the catalyst. But those allies, probably have the Japanese yen situation under wraps, or very likely. What to watch for is these developments in the yen triggering into a spillover in markets like Mexico. And that opens up a new theater in this kind of battle between the old and new world financial spheres that we're covering in Mind Print Hash. But this story likely plays out over several years, but we're opening up a very important new phase, is what it looks like to me. And steps look like what we're seeing is that integration of Mexico into the emerging stablecoin dollar system over, let's say several quarters or years, and away from that dying offshore dollar system. And if you look back in the history of ever since gaining its independence, it's been a tug of war between the old European worlds and the emergent kind of Western hemisphere, self-run, self-determining, kind of political and governance sphere. So huge developments in play. We're getting an early signal that Mexico has now entered the chat.
Yep. And with that, I think that's a good place to leave it. I think, like we said at the beginning, a lot of big developments, a lot of things that are really setting the stage for future new headlines, things like that. But again, as always, thank you, Matt, for walking us through your takes on kind of what we're seeing in that sovereign debt space. The Brady situation piece, I had no idea about all the kind of the back and forth that happened there. So it was good to dive into the Wikipedia article on that for myself too. So highly recommend that for all of you. As always, thank you for watching. I think next week, Matt and I will discuss if we're going to do an episode. It's up in the air right now, holidays, Matt's kids, all of that stuff. So we'll see if we decide to do that. If not, we'll see you in 2 weeks. Like, subscribe, tell your friends about us at Mindprint Hash on X, on Substack, on YouTube, at LeveredUST to follow Matt. I'm on X as well. See y'all next week.